Hello, everybody. Welcome. My name is Yaman Tazavar, and I provide a summary of daily news. Let's get started. You can see here that Dow Jones is down 0.6%, Nasdaq is down 1%, S&P 500 is down 0.7%, and Russell 2000 is down 0.4%. There's a number of companies who announced earnings today. Decker's Outdoor Company, that we're going to dig into a little later, is down 20%. Booz Allen Hamilton Holding Company is down 16%. Workday is down 12%, and Ross Stores down 11%. You can see on this heat map that Apple is leading the market down today, down 2.6%. And all Mac 7 companies are down. Financials are also down. Industrials are mixed. Other sectors are mixed. It's a bit of a defense off type of day due to Trump's tweet about EU tariffs. Let's start with this article. U.S. Senate votes to block California 2035 electric vehicle rules. Electric vehicles are getting a bit of a headwind from a number of regulatory fronts. This is one of them. The U.S. Senate on Thursday voted to bar California's landmark plan to end the sale of gasoline-only vehicles by 2035 that has been adopted by 11 other states, representing a third of the U.S. auto market. The vote sends to President Trump the measure to repeal a waiver granted by the U.S. EPA under former President Biden, allowing California to mandate at least 80% of vehicles to be electric vehicles by 2035. The vote is a win for GM, Toyota, and other automakers that heavily lobbied against the rules, and a blow to California and environmental groups that say the requirements are essential to ensuring cleaner vehicles and cutting pollution. California first announced a plan in 2020 to require that by 2035, at least 80% of the new cars sold be electric and up to 20% plug-in hybrid models. This Senate vote is illegal, California Governor Newsom said, adding the Senate action would cost California taxpayers an estimated $45 billion in additional healthcare costs. Since 1970, California has received more than 100 waivers under the Clean Air Act. Senate Republicans rejected the advice of the parliamentarian in moving forward. In March, the Government Accountability Office said the waivers cannot be repealed under the Congressional Review Act, which only requires a majority of the U.S. Senate. The fact is these EV sales mandates were never achievable, the group's CEO John Bozola said. In reality, meeting the mandates would require diverting finite capital from the EV transition to purchase compliance credits from Tesla. So Tesla is going to be losing the revenue from such compliance credits now. Earth Justice President Abigail Dillon denounced the vote, while our Republican leaders may try to put the horse back in the barn. When it comes to EVs, the world has already shifted under their feet. I don't think that's necessarily true. GM praised the vote, saying it would align emission standards with today's market realities. The Senate separately voted Thursday to rescind the EPA's 2023 approval of California's plan to require a rising number of zero-emission heavy-duty trucks and to bar California's low NOx or low nitrogen oxide regulation for heavy-duty highway and off-road vehicles and engines. A separate bill passed the U.S. House of Representatives on Thursday would end a $7,500 tax credit for new EVs, impose a $250 annual fee on EVs for road repair costs, and repeal vehicle emissions rules designed to prod automakers into building more EVs. It would also phase out EV battery production tax credits in 2028, which Tesla makes, I think, more than $1 billion a year on this. If upheld by the courts, rescinding California's rules will make it easier for automakers to delay and cancel some EV production. Automakers had warned in the coming months they might have been forced to limit gas-powered vehicles in some states. California's rules require 35% of light-duty vehicles in the 2026 model year to be zero-emission models. Automakers say it is impossible for them to meet that figure, given current EV sales, which are 10% or lower in some states adopting the rules. All right, next article. This one is about the Xiaomi YU7, and it goes on for a long, long time. I'm not going to read it all, but I just want to say that I think this vehicle is deeply underrated by everyone. If you read through this article, you're going to find that features that even the Model S and X does not have is included in this vehicle. It looks great. It goes for 500 miles, and it's going to be cheaper than the Model Y. So I highly recommend people to look into this vehicle more. We looked into it a little bit yesterday, but I don't think we did it justice. I think the sales numbers coming out of China will prove that this vehicle is unmatched from Xiaomi. So I think YU7 will do even better than the SU7, which overtook the Model 3 within the first year. All right, let's move on to as tariffs loom, prices for lightly used vehicles rise as supply shrinks. The average sales price of a 3-year-old used car in America surpassed $30,000 for the first time since 2023. The average age of used cars returned to dealerships has gone up, attributable to the low amount of new car sales during the semiconductor chip shortage several years ago. While shoppers looking to buy a newer used car may have to pay more, drivers returning their leases may see a higher payout or trade-in value for their vehicle. According to a new report, used cars are more expensive than they've ever been in years. A May 22 report from Edmunds indicated that the first quarter of 2025, the average transaction price for used cars 3 years old or less jumped above $30,000 for the first time since 2023, which obviously has implications for inflation numbers. The price of lightly used vehicles closed in on average sales price of the brand new cars, making it just $17,000 less expensive to buy used rather than new. That is the narrowest difference between new and used car prices since 2022, Edmunds reported. The report also indicates that the average age of vehicles traded in has grown from 7.3 years old to 7.6 years old in the span of a year. The shift, which indicates a tougher market for potential buyers, may result from the after effects of the pandemic-era semiconductor chip supply shortage, coupled with tariff-related anxieties among buyers. Chip shortage ripple effect. The leap in used car prices can be attributed in part to the semiconductor chip shortage from the COVID-19 pandemic, the report said. Leasing dropped sharply in 2022 and 2023, meaning fewer 3-year-old used cars are returning to dealerships in 2025. As supply shrinks, prices go up. All right. Let's move on to the next article. There's a big bet that the markets will go up. Mystery options buyer bets some $3 billion on US stock rally. An institutional investor's multi-billion dollar bullish bet on US stocks has become the talk of the options market. Over the past month, market participants have noted steady buying of mostly June 2027 call options across a swath of large US equities. Estimates vary of the total premium being spent, with Nomura Holdings tallying nearly $3 billion. This is interesting. I'm going to look into this a little bit more, and then we can talk about it more the next time we chat. Bank of Japan. So there's some, as we discussed in previous episodes, long-term yields of many countries around the world are going up substantially, and Japan is leading the pack. So, these long-term yields across each country doesn't move independently. They have some correlation. So it's important for investors to kind of keep this in mind as well. Bank of Japan Governor Yuda, economic future very uncertain, concerns about Trump tariffs. On this 22nd, 23rd Japan time, Bank of Japan Governor Kazuo Ueda recognized that the future continues to be very uncertain, over the Trump administration's tariff policy regarding the impact of the economy. He said, "We have to look at the data from now on." He said at a press conference after the closing of the meeting of finance ministers and central bank governors of 7 major countries held in Banff, Western Canada. Regarding the tariff policy, the fact that the US and British governments agreed on a trade agreement and the progress of trade talks between the US and China were evaluated as positive movements. On the other hand, he emphasized that there is still a lot of uncertainty about how tariffs will affect the economy, no matter where they settle down. When asked about the increasing supply and demand anxiety of ultra long term government bonds or the rising yields, President Ueda said, "I will refrain from commenting on specifically on short term interest rate trends. I would like to pay close attention to market trends," he added. Okay. You can see here in Japan's sticky inflation going back up in recent months, now at 3.5%. Japan's CPI pickup, rice price surge raised pressure on Ishiba. So interesting. The fiscal situation of the US may not be the primary reason why we're seeing a long-term yield surge in the US because it's happening across the world. And some of these countries that are seeing this 30-year yield surge don't really necessarily have the same fiscal situation that the US has. So that's interesting. On the other hand, German wage growth slows sharply as economy struggles to grow. German wage growth has eased significantly, and economic weakness suggests future deals will likely be much lower than in the past, according to Bundesbank. First quarter negotiated pay, including ancillary agreements, rose just 0.9% from a year ago, compared to a 5.8% gain at the end of 2024, the central bank said Thursday in its monthly report. Now, let's look at the Decker's earnings. The stock plunged 20%, and I'm trying to see what type of insight we can gain out of this in terms of macroeconomy. Decker stock plunges as Hoka maker does not issue fiscal year outlook on tariff pressure. Decker's outdoor shares are tumbling Friday after the UG and Hoka parent did not issue a full year outlook because of the uncertainties around tariffs. The company, which makes many of its products in China, said it expects second quarter net sales of $890 million to $910 million, below Visible Alpha consensus. Citi analysts Friday struck with their buy call and $150 price target on the stock, saying a stock sell-off provides an especially favorable entry point. I don't know about that. Decker's outdoor shares are tumbling by nearly a fifth in Friday trading after Uga Hoka parent did not issue a full year outlook. Given the macro uncertainty, the company will not be providing full year guidance. Okay. Let me see if there's any other reported earnings per share $1 on revenue of $1.02 billion. Okay. Decker's Brands also said it had appointed a new person as chair of the board, effective immediately, who's retired 6 years into role and 14 on the board. Decker shares are down 50% so far this year, entering Friday. So that's really interesting. US new home sales unexpectedly rise in April. Sales of the new US single family homes unexpectedly increased in April as builders lowered prices to lure buyers, but rising mortgage rates and uncertain economic outlook remain constraints on the housing market. Okay, this is a very volatile. New home sales are a fraction of the overall market. So it's not that surprising. I just want to kind of get the headline on this. New home sales make up about 14% of the US home sales. Okay. No info pricing here. Well-known investor is likely to sell NVIDIA ahead of its earnings. NVIDIA has earnings announcements, I think, on Wednesday. So I'm going to be digging into NVIDIA a little bit more in the coming episodes. Well-known investors likely to sell NVIDIA ahead of its earnings. NVIDIA split its stock a year ago and probably won't do this again in the near future. The GPU company's revenue has grown for 8 consecutive quarters, has an impressive gross margin of over 70%. Tariffs are a concern, but NVIDIA is investing heavily in US AI infrastructure. NVIDIA was unstoppable last year when it added over $2 trillion to its market cap. Along the way, it split its stock for the second time this decade and sixth time overall since going public in 1999. Companies often outperform the market, blah, blah, blah. Let me just kind of read through this real quick. A bit of a verbose article here. I'm going to skip this one. Now, this one, however, I think is pretty interesting too. Double whammy for Wabash. Two key agencies cut debt rating on trailer builder. Okay. Before I dig into this, let's look at this graph of the stock. You can see here it's down quite a bit in the last year, 61%. And this is a company with decades of history, trading at the lower end of its historical price range. American Diversified Industrial Manufacturing Company and one of North America's largest producers of semi-trailers and truck bodies. The company specializes in the design and production of dry freight vans, refrigerated vans, platform trailers, liquid tank trailers, truck bodies, and composite products. Founded in 1985. And the reason why I look at this is a transportation company, right? So it may have some implications for the macroeconomy. And this is before this last double whammy. Trailer manufacturer Wabash National, which has seen its stock price drop more than 60% the past year, saw its debt rating downgraded by both S&P Global Ratings and Moody's this month. The latest move came earlier this week when S&P Global cut its rating on Wabash to B plus from double B minus. The move was foreshadowed in November with the outlook negative. Okay. Same with Moody's. Both ratings are 4 notches below the cutoff at S&P between investment grade and non-investment grade debt. Interesting. Wabash National has been at B plus as previous in the past decade. Okay. Now let's read this paragraph here. The note from the credit report. Wabash National's credit measures will worsen below expectations for the rating in 2025 as trailer deliveries have declined from freight carriers delaying capital expenditures. Freight carriers delaying capital expenditures. S&P said in their report. The timing for recovery and the magnitude of a potential rebound is uncertain, and we see significant risk to the forecast. However, our base case reflects the assumption that trailer deliveries will improve somewhat in 2026, which could improve the company's credit measures. So, despite the assumption, they lowered the credit rating. And if this doesn't happen, then things are going to get worse. And so we're seeing now a number of companies having financial difficulties, from Tesla to this trailer company and to other companies as well. That's why I think the unemployment rate will start rising throughout the rest of the year. All right. Quick review of the data. Markets are recovering a little bit as of 1 p.m. Eastern, but still negative for the day. Thank you very much, everybody, and enjoy your weekends. And I will chat with you all next time. Take care.